It's Wednesday, October 16th. It's time for our weekly webinar. Good morning, everybody. Good to see you. Thank you for saying hello. It lets me know that everything's working well, so I really appreciate that. We're going to have our normal format today. We're going to go over our Slott updates. We're going to talk about the markets, and then we're going to have our financial focus, our financial planning strategy discussion. And today is how and when to pay tax on your Roth conversion. So here we are deep in Roth conversion season. I always tell people that accountants are very, very busy between January and the tax filing deadline in April. And we're very, very busy from about September to the end of the year. So bear with us as we work through things. There's many of you folks that we're taking care of regarding Roth conversions. We want to get it right. Then this is actually a much bigger discussion than I thought it was going to be as I was laying it out. I just want to remind you of the goals I have for you as listeners. So thank you, Leighton. I appreciate that. I want you to be inspired to make changes. You know, we're overcoming years of programming about some traditional strategies. You know, there's old paradigms, saving tax deferred accounts. So that's the best way to go. We've been told that may not necessarily be the case for you. Not really being very strategic about your spend down, and that you'll be spending less money in retirement. That's not what we see with people. Of course, the fundamentals are very, very important. Proper investment management, low cost and efficient investment management. All those are very, very important. But we want you to be inspired to make changes in how you're doing things. We want you to open your mind to different ideas and ways of thinking about planning and investing. Stay educated. This webinar, this podcast, if you're listening to this on podcast, is about being educated. So we want this education so you feel confident in the plan and strategies that are put in place, and we want you to stay updated. So check in here periodically. I do one of these almost every week. We want you to stay educated. We want you to stay updated. So check in here periodically. Not only do you have the opportunity to listen live when I do the webinars and the podcast. Well, excuse me, you can't listen to the podcast live. But if you're on our emailing list, I send the recording out to you. If you're subscribed to our YouTube channel, which I hope you are, then you get the video, the recorded video, as soon as it's available. What we do is we take this video and we go through and make some edits and just clean it up a little bit because this is live. Thank you, Denise. And then it's a little more condensed. But you have that video that comes to you right away in your notifications if you get notifications on YouTube, which also you should. And then we also break down a second video, which is just our financial focus, which is usually only about 15 minutes. So you just listen to that portion. So you've got a lot of different ways to hear this material so you can stay updated. We want you to stay updated so you can make adjustments along the way. All right, so let's talk about what we have coming up. I told you last time that we have some guests that are coming. Heather Schreiber is going to be with us on November 6th. So Heather is our resident Social Security expert. Heather's one of the best in the nation, and we're happy to have her on our team. And we're going to be talking about Social Security claiming strategies and answering any questions you have about Social Security. So that's November 6th. And on October 30th, we have Brian Adler. Brian Adler is an exceptional elder law and estate attorney who we do a lot of work with, and we're going to talk about those matters, elder law and estate planning. There is no webinar next week, so next week I'll be traveling out to my Ed Slott training event out in California, and I'll be gone for 3 days, Wednesday, Thursday, and Friday. So there will be no webinar next week. I'll see you the following week where Brian Adler will be joining us. All right, let's jump into our Slott report here. So I'm going to share my screen so you can read along. So this is complex information, I know, and we'd like to share it on the screen so you can join us in reading along. If you're just listening on the podcast or on YouTube and something strikes you, you can always go back to the YouTube channel, find the section, and it'll be indexed, and then you can read along with the screen. All right, I am just turning up my gain a little bit to see if that helps. But today we're going to talk about nuances of NUA, net unrealized appreciation. So this is kind of a little known part of the tax code that can help if you have company stock in your company retirement plan, it may help you save a lot of tax money when you transfer those funds out. So it's something that sometimes can make a big difference. Sometimes it really doesn't make sense for you to go through the process, and that has to be evaluated, of course, on an individual basis. But the net unrealized appreciation can be a big substantial savings for some people. So this is written by our friend Andy Ives. Andy writes, "We have written about the net unrealized appreciation tax strategy many times. And in fact, Andy and I did a webinar about this a few years ago, so you can find that on our YouTube channel if you have more questions about NUA." And Andy writes, "Generally, after a lump sum distribution from the plan, the NUA tactic enables an eligible person to pay long-term capital gains tax on the growth of company stock that occurred while the stock was in the plan. But there are finer points to NUA, and here are some of the more nuanced details. Step-up basis. Now, NUA, meaning the appreciation that occurred in the plan prior to the lump sum distribution, never receives a step-up in basis. If the company stock is held by the former plan participant upon his death, the beneficiary of that account will pay long-term capital gains tax on the NUA no matter when the shares are sold. But what about any appreciation of the stock after it was distributed from the plan? Appreciation after the lump sum distribution does receive a step-up in basis. This is something that people forget about. A strategy many people have in their taxable accounts or non-IRA, non-retirement accounts is, if I'm going to leave this to my heirs, I'm going to not sell any positions, and I'm going to wait until we get a step up in basis under the current tax code. When you pass away, your basis is stepped up to your date of death, and that could be another tax savings for people. But it's important to remember that if you transfer company stock under the NUA allowance, then you don't have that ability to have that step up on that NUA portion, net unrealized appreciation portion. So here's an example. John completed a proper NUA distribution 10 years ago of his company stock that was valued at $500,000. At that time, John paid ordinary income tax on the cost basis of his shares, $100,000, and he anticipated paying long-term capital gains on the NUA of $400,000 when he sold the shares. John held all the shares until his death, when the total value had increased to $750,000. John's beneficiary, his daughter Susan, immediately sells the shares. She will pay long-term capital gains tax on the $400,000 of NUA. However, Susan will get a step-up basis on the $250,000 of additional appreciation and owe no tax on that part of the transaction. The original $100,000 is also tax-free as a return of basis. John already paid tax on that $100,000 when he transferred it over using the NUA allowances. The specific identification method. Retirement plans will typically use an average cost per share to determine the net unrealized appreciation. Over the years, as the company stock price goes up and down, a plan participant will acquire shares at different price points with each salary deferral. However, the plan may not track all these different purchase prices. Instead, the plan could use the total purchase amount, the cost basis, versus the current value of the stock. For example, if the current value of the stock within a 401k is $1 million, and if the total amount used to purchase the stock was $400,000, the NUA, or net unrealized appreciation, is $600,000. Average cost per share is cost basis, $400,000, divided by the total number of shares owned within the plan. If a plan participant maintains detailed records and documents the specific historical stock purchase prices, the person could decide to only include the low cost basis shares in an NUA transaction. The high cost basis shares would be rolled to an IRA and excluded from the NUA calculation. By following the specific identification method, targeting the low basis shares, a person could further maximize the NUA tax strategy. This is something that often isn't talked about in the NUA strategy. And another important point about this Slott group and the information that they bring me, and through me, I can bring to you. In plan Roth conversions, caution: when an NUA trigger is hit, a plan participant does not have to act immediately on an NUA distribution. However, if the trigger is activated by certain transactions, like a normal distribution, the NUA lump sum withdrawal must occur within that same calendar year. If not, the trigger will be lost. Be careful and In-plan Roth conversion is considered a distribution and will activate an NUA trigger. 10% penalty for those under 55 years old. Assume a plan participant was under 55 at the time of separation of service. As such, she could not leverage the age 55 exception to avoid a 10% early withdrawal penalty. But there is a silver lining with NUA. There is a silver NUA lining. If she pursued an NUA transaction before age 59 and a half and rolled over her non-stock plan funds, she would owe a 10% penalty only on the cost basis of the shares. If the appreciation is high enough, it could be advantageous to pay the 10% penalty on the cost basis to preserve the long-term capital gains tax break on the NUA. The NUA tax strategy is part art and part science. To maximize the benefits, understanding the different nuances is essential. Boy, isn't that the truth? And Andy is an absolute expert in this. I've actually been in client meetings and have emailed Andy a specific NUA question and have gotten a response, a very detailed response, before the end of the meeting. So Andy's also very, very responsive, as are all of the analysts in the Slott group. So now we're going to move to the Slott mailbag. So this is when people write into the Slott group and they have questions about different things going on in their life and different experiences they're having. So again, Andy is answering this mailbag today. And the first question is, there we go. The first question is, if a client passed this year with 4 adult children inheriting equally, and each beneficiary is using the 10-year rule, how do they determine yearly required minimum distribution calculations? Is it based on life expectancy or on a number that will empty the IRA within 10 years? Thank you for your help. So Andy answers Sherry, when RMDs apply within the 10-year period, and assuming the 4 inherited IRAs are properly established, each beneficiary will use his or her own age to determine the appropriate RMD. Use the beneficiary's age in the year after the year of death, 2025 in this example, to determine the initial factor from the IRS single life expectancy table. Then subtract 1 from that factor for years 2 through 9 of the 10 years. And deplete the entire account by the end of year 10. That's 12/31/34 in this example. A beneficiary can always take more than the RMD, which could be a wise tax planning decision based on what their needs are. So if you don't know what the heck we're talking about with the single life expectancy table, you can actually download that table from our website. You go to, here, I'll just show you. Just give me a second. I'll show you exactly where it is. So here's our homepage. You go to Education and Resources. Hit this drop-down menu. You drop down to this Slott corner. So that's Ed Slott's information. And this will load. There's a couple of videos that you should take the time to watch. They're very, very good. But you should you can download the single life expectancy table, the RMD table. It's actually a two-sided document that has the regular life expectancy table that's used for RMDs. Single life expectancy table is for inherited IRAs. But you click this, enter in your email address and your information, and then you'll be able to download these forms. Okay, let's get that out of the way. Next question. My wife's mom, age 96, died in June and still has about $6,000 in IRA assets. She has been taking required minimum distributions, or RMDs. Do we need to take an RMD for her in 2024, or can the remaining funds pass to her beneficiary? This is a great question. The answer is, Michael, all or whatever portion remains of your mother-in-law's year of death RMD becomes the responsibility of the beneficiaries. To avoid a late penalty, mom's final RMD must be taken by December 31st of the year after the year of death, 12/31/25 in this example. This is the new extended deadline. So that just came about in the past few months. To help streamline tax reporting, a custodian will typically establish an inherited IRA for the beneficiary and pay the year of death RMD from that inherited account. Note, if there are multiple beneficiaries, the year of death RMD does not need to be spread equally among them. As long as the full amount is taken, the IRS will be satisfied. Good work again, Andy. I look forward to seeing you next week if you're listening today. All right. Let me just check to see if no questions. Good. All right, let's move into our market snapshot. So we're going to first look over our analyst reports, and we're going to talk about what happened last week. And the first thing was we had the FOMC minutes. So that was from the Federal Reserve, and we saw the September Federal Reserve meeting minutes, and that resulted in an interest rate. The Federal Reserve meeting in September resulted in an interest rate cut of 0.5%, and showed that participants were more divided than the one dissenting vote indicated. Remember when that vote came out, we were told that one of the members was a dissenting vote. They said no, they wanted a smaller cut. But the notes tell us it's a little bit different than what they had said before. A few officials thought a 0.25% cut could signal a more predictable path of policy normalization. Additionally, the notes revealed that some officials who supported the larger cut could have also supported the smaller move. So our analysts say it was clear going into the meeting that investors were divided on how large the cut would be, and now it's also clear that the Fed had the same divisions. Our guess is that Chairman Powell was in the larger cut camp, and voters didn't want to defy the chairman. When they talk about voters, they're talking about the other members of the FOMC committee. What this means for future meetings is unclear, but the slower approach camp may have some leverage, especially with the solid economic data that we've seen. Last week, we reported this because it came out just before the webinar, but the consumer price index rose 0.2% month over month and 2.4% year over year, which was a bit higher than expected and a bit lower than the previous month. Core prices, which exclude food and energy, rose 0.2% month over month and 3.3% year over year, above both the estimate and the month prior. So our analysts write that the consumer price index came in a little hotter than expected and may reinforce the thought that inflation may be a little sticky and could play into the Fed slowing or pausing their rate cuts in the coming month. It's going to be really interesting to see what happens with this, because I've said all along it's going to take us a while to come out of this. I was really surprised at the CPI report last month, but we'll see what we get. Or this month, but it will for September, but we'll see what we get next month. So the wholesale price, PPI index, the prices at the wholesale level were flat month over month and up 1.8% year over year, while core prices rose 0.2% month over month and 2.8% year over year, slightly ahead of expectations. So our analysts say, although this report doesn't garner as much attention, continued higher core prices will be watched closely to see what other rate cuts are pending. Not a lot going on this week. So Thursday, we have retail sales. The consumer has held up well, and investors will be looking to see if that continues heading into the holiday shopping season. And we also have jobless claims. So that's going to be affected from the hurricanes that we are seeing in the southern part of the country. But we'll have to see what the jobless claims have to say tomorrow. All right. The markets were strong again last week. So just looking at my markets review and a glance with you, the Dow Jones Industrial Average was up 1.22% at 15.42% for the year. The S&P 500 was up 1.13% for 23.24% gain for the year. The NASDAQ was up 1.13% for a 22.89% gain for the year. And we just keep hitting these all-time highs. The MSCI World Index, not including the U.S., was up slightly, 0.21%, almost just shy of 12% for the year, 11.68%. Emerging markets was down a bit, 1.66%. Europe, Asia, and the Far East was up 0.26%. Small caps, so global small caps was up 0.27%. Bonds were down last week. So the U.S. aggregate bond index is fighting again. That was down 0.46% and only up 2.93% for the year as of the close of business on October 11th. And what's interesting is even with the rate cuts that we saw, 0.5% rate cut, the let's just say the mid-range portion of the bond market is increasing again. So the 10-year Treasury was at 4.1%, which is an increase of the week prior of 3.9%. So it's interesting to see that it just goes to show you that the Fed doesn't necessarily control the bond market, right? It certainly has a lot to do with it, but it doesn't have everything to do with it. And the bond market is going to set its own price through pricing bonds, right? So yeah, that'll be interesting to watch what happens with the bond market for sure. And of course, as interest rates go up, bond values go down. So when we see an increase like that, where the 10-year Treasury goes up even slightly, 4.10% from 3.97%. So that's not a big increase, but it's enough to bring the U.S. aggregate bond index down about 0.5% over that period of time. All right, it's time for our financial focus portion of our webinar, and this is the financial planning strategy section. In this section this week, we're going to talk about how and when to pay tax on your Roth conversions. As I said earlier, we're deep in Roth conversion time here at Attleboro Wealth Management, and the question often comes about especially when we're talking to new people is, well, how am I going to pay this tax? There's a tax that's due with a Roth conversion. What's the best way to pay it, and how does it need to be paid? So I put this together, and I shared with you that as I was putting this together, it really became a much bigger topic than I thought it would be. I thought this would be a short little discussion, but I'm afraid it might get a little more involved, and I'm going to caveat it with, again, this is education, and if you haven't already subscribed to our channel, please hit the subscribe, like, and notification button so that you're notified when these videos hit. But this is education I'm bringing to you. It's not advice. So no part of this should be taken as tax advice, planning advice, investment advice for you. Use this information to stay educated, stay updated, but you should be having these tax questions with your tax planner, your tax advisor, your tax preparer. You should not be learning about your taxes, investments, and planning you can be learning about it, but you should not be taking advice on your taxes, your investing, and planning on YouTube, podcasts, or anybody else or anyplace else. So let's talk about it. So first of all, we're talking about Roth conversions. So I've got a lot of videos about Roth conversions, but let's just go over the basics of Roth conversions really quickly. So our financial focus, how and when to pay tax on Roth conversions. So let's first talk about Roth conversions. So I'm going to give just a basic instruction here. If you've never heard of a Roth conversion before and your first time tuning into the our webinar podcast here, and if you're listening to the podcast, you might want to go over to the webinar and watch the video because I'm here drawing on a whiteboard. But we break down our investments into three different buckets: taxable, tax deferred, and tax advantaged or tax free. The regulators like it when we call it tax advantaged. Now, our taxable accounts can hold mutual funds, CDs, individual stocks, bonds, exchange-traded funds, cash, whatever you'd like for the most part. And you get 1099s or sometimes K1s out of this bucket every year. And all these things, and you get these things, these tax forms, 1099s, for example, for interest, dividends, long-term gains, short-term capital gains, and this all equals tax, and it's a tax you have to pay every year. If you have gains, you have to pay tax on it. You earn interest, you have to pay tax on it. You receive dividends, they can be taxed two different ways. So it's a perpetual kind of tax. These forms are delivered to you every year. They're also delivered to the IRS, so you have to pay tax on it. Then we have the tax deferred bucket over here. So we talked about the taxable bucket. Then we have the tax deferred bucket over here. This is where your traditional IRAs sit, in your traditional 401ks, traditional 403bs, etc. This is money you promised to pay tax on later. You either got a tax deduction when you contributed to your IRA, for example, your traditional IRA, or you didn't pay tax on the money that went into it through a payroll reduction and your on your 401k contribution, for example. So you may, at some point, it may make sense for you to say, well, wait a minute. If I know that at some point I'm going to have to pay tax whenever money comes out of this bucket, it may make sense for you to pay tax earlier, like now, for example, when you know what the tax rate is, as opposed to in the future when taxes could be higher for you. And that's an individual decision that you should work through with your qualified financial planner, tax preparer, and tax planner. But if you decide that a Roth conversion is correct for you, or is right for you, you can take money from this bucket and convert it, move it over to this bucket. You determine what amount that's going to be by how much tax you're going to have to pay and what mathematically makes the most sense for you. And you don't have to do that all at once. If you have $1 million, for example, in this bucket, you don't have to convert $1 million all in 1 year. You can do it over time. And your job, or your job with your team, is to figure out what schedule works best for you. But the thing is, let's say this is the best thing for you, and you want to, and in your case, you want to get this whole $1 million over to this Roth IRA over time. Well, that may be well and good, but the cost of that conversion, the IRS says you can convert as much or as little as you'd like. You don't have to have income to do a conversion. There are no income restrictions on doing a conversion, so it's wide open. But you've got to decide what makes sense for you, and the cost of that is tax. So let's say it made sense for you to convert $100,000. And let's say, for this example, that you're in the 20% tax rate. Well, that's really easy math, right? $100,000 times 0.2%. So that's $20,000 that you're going to have to pay in tax. So now the question is, well, heck, how do we pay that tax? How and when and where do we pay that tax? Now, you might have another $1 million sitting in this taxable bucket. So let's just check in. So we talked about calculating your tax. So I'm using this 20% as an example. Folks, it's an example. It's an example. It's an example. It's an example. It's not necessarily your tax. You want to do that calculation with your tax preparer, your tax planner, your financial planner. So make sure you know how to calculate that tax properly, or have someone do it for you. This is what we do. This is what we're working on right now very intensely, is having conversations. So our team, we've got planners and a tax planner and a CPA on staff, and these folks are going through the plan, making sure we're hitting the right numbers, having conversations with their clients, talking to their tax preparers, and making sure we're really zeroing in on the correct Roth conversion amount and calculating that tax as closely as possible. So now, once you have that, the tax that you have to pay, in our example, $20,000, just in our example, well, now you've got to pay that tax. So there's a couple different places or ways you can pay that tax. The first is you can pay the tax from the taxable account. Well, if you have enough money sitting in this taxable account, that may make sense for you. It may make sense for you to pay that tax, that $20,000 out of that taxable account. You pay it every year with your conversion. It goes to the IRS, never to be seen again, but you never have to worry about it again. So I think 2 webinars ago, so 2 weeks ago, I did a webinar about the break-even point and opportunity cost of a Roth conversion. If you have questions about that, you should go back and look at that video. But this $20,000 gets to be paid out today at today's tax rates. You never have to worry about it. And this $100,000 that now you've moved over to the Roth IRA without conversion, as long as it's a qualified distribution, you will never pay tax on that money. So your future tax rate on that $100,000 and any gains that it has, as long as it's a qualified distribution, you're done. You've paid your tax. So if you think that this is the lowest tax you're going to pay, $20,000 over your lifetime on that $100,000, then it may make sense for you. And it may make sense to pay it right out of that taxable account, and now it's done. Well, the problem is that not everybody has the $1 million sitting in their taxable account, or maybe they have $1 million sitting in their taxable account, but there might be other things that they want to do with that $1 million. Maybe they want to buy a vacation home, or maybe they want to buy a second home, or buy a big boat, or pay for something, for their loved ones. I don't know, but people have goals, needs, and goals and needs that they want to address during their retirement. So I'm sorry, I jumped ahead, but if you pay from your taxable account, we're going to talk about the timing of those payments and the timing of the tax payments. So if you do the let's say you did your Roth conversion. So here we are, it's October. This is the end of the year. If you did your Roth conversion for that $100,000 and you have to pay the tax, well, the IRS wants you to pay that tax in your next estimated tax payment. So you don't want to wait until April 14th or, the tax filing deadline, April 15th or whatever date it falls on of 2025. You want to get that tax payment in with your estimated tax payment. So in 2025, it's probably January 15th, unless that falls on a Saturday, Sunday, or holiday. So you want to calculate that estimated tax due and get it in, and it's a little more involved in that. So this is a quote from our in-house CPA, and I'll just read it to you. You can read along with me. So, and his name is Sasha. Sasha writes, taxes due in the quarter you earn the taxable income. To reflect this on your tax return, you have to file Form 2210 and use the annualized income installment method, which allows you to show the IRS which quarter and how much you made in each quarter. So if you made all your income in the fourth quarter, you would not owe a penalty if you paid all the estimated tax with the fourth quarter estimate. You do have to file the form. You do have to fill the form in properly and elect to do this with Form 2210. So talk to your tax preparer about that. So you've got to do it properly. You can't just send in the estimated tax, let's say for the extra $100,000 in January, and say, well, the IRS is going to catch it. They're going to understand that I had $100,000 more in taxable income than I covered with this estimated payment. You have to tell them what's going on. So make sure you're talking to your tax preparer about that. So good information from Sasha. Thank you very much. So that's the timing on that. Now, we talked about if you did that Roth conversion in the fourth quarter right now, you did it October 16th, 2024. You want to pay that estimated tax by January 15th. What if you did it just a month ago in September in the third quarter of the year? Well, you're going to want to pay that estimated payment or the estimated tax for that third quarter estimate. So you want to make sure you understand the estimated tax dates and the filing rules. So great information again from Sasha. So now we know how and when to pay that tax if you're taking it from your taxable account. But back to our buckets. What if you have a use for this $1 million? Well, or you don't have the $1 million in there. What if you only have $100,000 in here and you don't want to and you don't want to spend it all on tax, and maybe you can't afford to spend it all on tax? Well, you can do what's called withholding. Now, there are some rules and nuances about this, and we're going to focus on coming back over here. We're going to focus on post age 59 and a half. So you're over age 59 and a half or under age 59 and a half, right? So this is pretty simple. Over age 59 and a half, it gets much more complicated under 59 and a half, and we're going to talk about that. So let's talk about over 59 and a half. You've attained the age of 59 and a half. Congratulations. That opens up a lot more opportunity for you. You should go out and celebrate that half birthday, have half a cake, do whatever you want to do, but it opens up a lot of opportunities for you. You know, the regulations say that you can roll your 401k, your existing 401k, and the 401k and the company you're working for, you can roll that into an IRA, and there may be some good reasons for that. But let's assume that you've got your money in an IRA and you're rolling it to your new Roth IRA that you've established, or maybe a Roth IRA you've had for a while, but you don't want to pay the tax out of the taxable bucket. You want to pay it out of the conversion amount. So now, still the same amount of taxes owed, that $20,000. Instead of it coming from the taxable account, let me change my pen so we can make this a little clearer. We'll make this green. It can come out of the conversion amount, and instead of $100,000 landing here, well, now we have $80,000 landing here, and $20,000 gets sent to the IRS from the conversion via withholding. So just like your company paycheck, you earn $1,000. Your company sends $200 in this example to the IRS. You get $800,000 deposited into your checking account. It's the same. It's the same idea. You're simply withholding the money from the conversion, sending the difference to the IRS, and the remaining amount gets sent to the Roth. Now, these numbers are all just examples. There are some more detailed calculations you have to do. We have a whole calculator to determine gross amount, net amount that's converted, and what the percentage rate is, and what the actual amount that goes to the IRS is. So it's much more complicated than just $100,000 times 20% in this example. But I'm just using these as an example so that you understand the process. So you can, in fact, do that withholding it if you're over 59.5. If you try to do this, if you're under 59.5, what is the IRS going to say? Well, the IRS is going to say the $80,000 conversion is fine, right? So we're going to pull this $80,000 out of here and make it a little clearer. The $80,000 conversion is fine. No problem with that, because the regulations, the code allows for these Roth conversions, even if you're under 59.5. The problem, if you're under 59.5, the problem is this $20,000 in tax. If you're over 59.5, it's no big deal, but the rules say if you're under 59.5 and you take a distribution out of your IRA, except for certain circumstances, including Roth conversions, then you have to pay a 10% penalty. So not only would you have to pay tax on this $20,000, but you'd have to pay another 10% penalty. So in most cases, we say, well, geez, if you're under 59.5, you can't do withholding. Except there are some exceptions. There is an allowance in the tax code, again, a little known section under section 72T. So read along with me with this excerpt. Under section 72T, 2A4, if the distributions are determined as a series of substantially equal periodic payments called a SOSEP over the taxpayer's life expectancy or over the life expectancy of the taxpayer and the taxpayer's designated beneficiary, the 10% additional tax does not apply. However, there are certain requirements. So I'm not going to read all these requirements, but I just want to share with you just some of the requirements. So I'm scrolling and scrolling and scrolling, and I think this is just section 2 and 3. So this, if you're going to embark on this 72T strategy, then you certainly, listen, you always want to work with a qualified tax preparer and tax planner and financial planner. But but especially if you're going to try something like this 72T, because there's certain requirements. The distributions, if the distributions are from any of the arrangements listed in items 1 through 3 of the Q&A in item 1, the taxpayer must be separated from service with the employer maintaining the plan before the payments begin for the exception to apply. So what I pulled those exceptions out. A plan described as Section 401A, which includes a trust exempt from tax under Section 501A, an annuity plan described as in Section 403A, an annuity contract described in Section 403B. So you've got to check, first of all, to make sure that you can do this from your plan. An IRA, you certainly can. That's not on the list. But once the SOSEP series of, this one always trips me up, series of substantial equal periodic payments. So once that series of substantial equal periodic payments is established, the taxpayer cannot make any additions to the account, nor take any payments from the account other than the SOSEP payments. Changes to the account due to investment experience do not affect this prohibition against making additional contributions to the account or taking distributions from the account in addition to the annual payment. The taxpayer cannot have more than one SOSEP in effect for the account for any year. The taxpayer does not modify the SOSEP other than by reason of death, disability, or distribution to a qualified public safety officer under Section 72T10 before the date that is the latter of the 5th anniversary of the date of the first SOSEP payment and the date of the taxpayer reaches 59.5, whichever is longest. So it does say that you've got to do these calculations based on your life expectancy, but you have to hold it at least. You only have to continue them for the period of the 5 years or until you reach age 59 and a half, whichever is greater. If the taxpayer modifies the series of payments before that date, an additional recapture tax applies. For information regarding certain changes that are not considered modifications to they gave a reference for exceptions. But anyway, so it is possible, and we just had somebody who this may make sense for, but it is a complicated process. What you want to do typically is if you have an amount that you're going to use to pay your tax, and it's not likely to generate the high amount like we showed with $100,000 conversion, $20,000 in tax, because of the 72T calculation. What we typically see are much smaller allowances, and they have to stay, the equal payments over the period of time I talked about. So what we'll do is we'll set up a separate account. So if you have one IRA, we'll set up an IRA separately just for that 72T until the person reaches age 59 and a half or meets the requirements, 5 years, 59 and a half, whichever is greater. And then we'll stop that and then just recover and continue to do the typical withdrawal schedule. So this 72T, if you hear it out there, is not for the faint of heart. It can be done, and it certainly can be a good practice if it works for you to be able to do Roth conversions sooner than waiting until age 59 and a half, because as we get closer to that 2030 date, we increase our tax rate risk, the risk that taxes are going to be much higher than they are today. So I told you that was a lot more than I thought it was going to be, because we get into the easiest way and probably the most efficient way, certainly the most efficient way to pay tax on Roth conversions is, number one, take it from your taxable account. If you've got substantial funds in your taxable account, figure out the amount that you're going to convert, pay it from your taxable account. Make sure you get your estimated payments in on time. Make sure that you file the appropriate form so the IRS understands what you're doing and you can track it if they question it. But if you can't do that and you're over 59 and a half, if you can't make the payments from your taxable account, well, you can do it via withholding. We have many, many people doing those conversions and taking the tax out of the withholding. For most people, it's better to do that than to not do the conversion at all. It's best if you can pay it outside of the conversion, but better to do the conversion than not do it at all. This only works if you're over 59 and a half in most cases. In some cases, it can make sense to utilize this 72T strategy, but I showed you, and you can go, here's the website, so you can copy that down, or you can just Google 72T distributions, and you're going to find the same website, and I encourage you to go through and look at it. This long section is only two of the many sections in the Q&As. This isn't even actually the code, it's just the Q&A. So you want to make sure you're working with a qualified person who understands this and has the you've got your team in place. If you're gonna embark on anything that's any of these tax strategies to make you more tax efficient, you should have your retirement team in place. And if you don't know what I'm talking about, that you can go back to a video and I've got on your retirement team. But in short, you want a qualified, certified financial planner, somebody who focuses on tax efficient strategies and effective distribution from your accounts across all retirement accounts, taxable accounts, traditional retirement accounts, Roth accounts, etc. You want a qualified CPA who understands this, who isn't just a rear view mirror driving CPA who does your reconciliations at the end of the year, files your tax returns. You want someone who's more planning mindset. Like the fellow on our team. And then you want a good attorney. You want a good estate attorney. And for most people, you want that estate attorney to also be an elder law attorney. So that's a good retirement planning team that you should have. And that's what's going to help you get to your goals most efficiently and hopefully saving a boatload of money and unnecessary taxes. All right, so here's a couple questions. Jerry said, will you touch upon impact of Roth conversion, taxation, Social Security benefits, and IRMA penalties? Well, we have in the past, Jerry, so I'm not going to touch on it today, but I'll just mention that any conversion amount will increase your taxable income. So it's going to, your taxable income and modified adjusted gross income is what's used to calculate your IRMA penalties or surcharges. And the IRMA surcharges are income-related monthly adjustment amounts. There's a whole section. I'm going to write a whole list of videos to include. But that's important to know. And then Roth conversions also increase your or add to your provisional income calculation. And provisional income is the calculation the IRS uses to determine how much of your Social Security is taxed. So certainly, Jerry, you want to pay attention to those things. Thank you. What happens if you don't pay the conversion tax? Ann writes, what happens if you don't pay the conversion tax until the tax filing date? Are you saying there's a penalty for that? Yes, there could certainly be a penalty for that. So if you wait until April 15th, for example, the tax filing deadline in the following year, you could certainly see a penalty for not paying your proper estimated payments. Good point, because I didn't mention that, so I appreciate you saying that, Ann. But anytime I say, you should do this, the answer is if you don't do this, you're likely going to have a penalty, right? Okay, well, I hope that was helpful. I hope you learned something new today. Remember, there is no webinar next week, but we'll be back the following week with Brian Adler, and we'll talk about estate planning topics, timely estate planning topics. So I look forward to seeing you all then. I'll have a bunch of new information from the Slott group. I can't wait to go and see what they have for us, and I'm looking forward to that. And I'm looking forward to seeing you again in a couple weeks. Take care. Enjoy the rest of your week. Bye-bye.